Good afternoon, everyone. Thank you for joining us for this short Zoom talk to go over some year-end tax planning topics. My name is Zach Ungerott. I'm with Hightower St. Louis Wealth Advisors. And I'm joined here by Ann Holtshouser. Ann's a partner at Smith Wallace, and she's been gracious enough to give us some of her time today. So Ann, thank you for joining us.
Thank you, Zach. I appreciate it very much.
As we get closer to the end of 2020, as nobody's probably counting down the days till we get out of this year, I thought it'd be a good idea to go over some ideas or topics that the individuals or couples can think about prior to the end of the year in terms of tax planning.
Right.
So first, let's jump in. And again, this is going to be more for your W-2 employees. Why is it important to verify tax withholding prior to the end of the year instead of waiting until you get your W-2s the following year?
Sure. So when you think about the federal tax withholding, let's just talk about federal, but it's just an estimate of what your tax liability is going to be. And it really just deals with that particular type of income. So if you're talking about wages, it's really just withholding against those wages themselves. And it doesn't factor in any other type of income. So oftentimes individuals have pension income, Social Security income, if they're working with Hightower, they're going to have dividend and interest income. So generally speaking, a lot of those types of income don't have any withholding. So you want to consider what is the withholding that you've got year to date, and is it sufficient to cover those additional sources of income? Or is it maybe too much if you've got some additional deductions during that year? You want to maybe cut back and you don't need as much withholding. So you want to try to get it as much on point as you can. When we work with our clients on projections, one of the main things that I always strive is to not have any surprises. And if you're under withheld when you file your tax return in April and there's a big surprise of a balance due, that's not very pleasant to talk to a client about. And then they're coming to you and saying, I need to withdraw some funds from my investments. So, also to avoid penalties, there can be penalties on under withholding and underpaying your tax. To avoid that, you should be paying at least 90% of what your total tax liability is due during the year, or at least 100 or 110% of your prior year tax liability. So it can be a gauge. And penalties, it's taxed at it's based on the current interest rate with the IRS, which currently it's only 3%. It's not really, really high. So it is a consideration, but penalties are not, no one wants to pay any penalties. So if you can avoid that, looking at the withholding before year end is a good thing to do.
And let's say if you are under withheld for the year and you're coming into December, what are some of the options people can have to adjust that withholding and make sure they kind of meet that threshold for the year?
So you can adjust it for the final paychecks that you've got coming. Most people probably have a couple more paychecks for the year. So if you talk with your HR department, you can submit a revised Form W-4 and request some additional withholding to be held from your final paychecks. And that can increase it. And the benefit of doing that is that does spread the withholding out as if it's been paid over the entire year. So it's not just a fourth quarter estimate payment, which only deals with the last 4 months of the year. It does consider as if it's been paid for the entire year. So some people do have their entire paycheck withheld if they, they know they're going to have a big balance due to avoid some penalties. But revising your W-4 is the way to go there.
Okay, great. Thank you.
Sure.
So on to the next topic. What are some year-end ideas that individuals can use to help reduce some tax liability? I know we work with our clients in terms of charitable giving and things like that. But I'd love to get your perspective on some ideas that they could they could utilize?
Yeah, well, the first thing, I mean, to really think about is there a way to accelerate deductions? Given that the standard deduction has gone up and almost doubled from what it used to be, there's not a lot of individuals, well, I should say that there are a lot of individuals who no longer are able to itemize right off the bat. With the limitation on the state income tax deduction, it being $10,000 for most individuals. If you're married filing joint, that means you have $14,800 of other deductions to come up with. And if you've got your mortgage paid off, then you're not going to be able to itemize all the time. But if you can itemize, like you said, oftentimes we're looking at charitable contributions to potentially increase before the end of the year. Some other deductions, possibly contributing to an IRA if you're eligible. So you do want to factor in, do you have another plan that you're participating in? You might not be able to gain benefit from a deduction to for a contribution to an IRA. But that could be $6,000 or potentially $7,000 if you're over age 50 and you want to contribute the makeup amount of $1,000 additional on that. Also potentially a 529 plan contribution. So I think we might talk about that a little bit more. I know you mentioned we'd talk about that in more depth, but making that deduction contribution gives you a deduction on your state tax return, and you can benefit there.
Great. And yeah, and let's maybe jump ahead and kind of hit on that 529,
Sure.
Those 529 accounts. As coming from the wealth planning side, those are great tools for college savings. You get the great tax deferral for those college expenses. But again, there's also the other side from the tax piece on some benefits that you can get from using a 529. And can you go into that a little bit?
Sure. So the 529 plan in the state of Missouri, you can get a state deduction. It's only a state deduction, not a federal one. But you can deduct on a single tax return up to $8,000 and $16,000 on a joint tax return. So if you're at the top tax rate, and in 2020, that's 5.4% in Missouri. So if you've got, if you contribute the maximum amount, you can save up to $432 or $864 given at that rate. So that's some savings, but the real benefit comes in the tax-free withdrawal of those funds when you do use them for education expenses. So once you put the money in, it'll grow tax-free, and as long as you use the funds for qualified education expenses, so you do need to be conscious of that when you do make the withdrawal. Tuition pretty much qualifies, but there are some other expenses that you can look to as well. So if you're thinking beyond just general tuition, make sure that those expenses are qualified expenditures. So those, whatever the account earns, all of that is tax-free when it's finally withdrawn. And then the other thing to consider is, you mentioned college education. Well, with the tax law changes in recent years, you can use the funds to pay elementary school education, grade school, as well as high school. So K through 12, you can use up to $10,000 per student per year to pay for those expenses. St. Louis has a lot of private education institutions, and so it can be used for that as well. So investing early into the 529 plans can be very key. So,
great. Yeah, no, thank you for expanding on the secondary school, because that's definitely a new rule that people are starting to utilize.
Yeah, it's a new thought process. I think not everybody's needs it or will be able to benefit from that, but it is a new feature. And there's also a feature now where you can pay up to $10,000 against student loans, and that's a lifetime expenditure from the 529. You can't do that every year, but at least that's another benefit that you can use for the 529 plans for. And I don't know, did you want to discuss a little bit about maybe front loading 529 plans?
Yeah, that would be great.
Yeah. So, like I said, you can get a deduction of 8,000 or 16,000, single or joint. And so you can, though, contribute more than those amounts. And oftentimes an individual might want to, let's say, put some money aside for their grandchild, and they want to fund a large amount up front. Well, one thing we've had clients do is contribute up to, let's say, $75,000, because you can use the gift tax annual exclusion and apply it to a 5-year time period and spread it out. You do have to file a gift tax return, but you can spread it out as if you've gifted $15,000 per year to that individual. And so the benefit of that is really front load the 529 plan, and it now has a large amount and it will continue to grow tax free. You're not waiting to fund it year to year, and right off the bat, you've got funding that's growing tax free. So you lose a little bit on the deduction side because you don't get the deductions every year, but you still get the tax free growth when you use it for qualified expenditures.
Right.
Mm-hmm.
Great. Thank you.
You're welcome.
So let's go back to the conversation that a lot of people have, and especially in years where the market's pretty volatile, and talking about Roth conversions. And obviously, taxes probably won't be going down. There's always that prospect of tax rates going up in the future. But can you walk through some pros and cons of doing maybe a partial or a full Roth conversion, and kind of what to think about before completing one?
Yeah, so Roth conversions, there's something, if you've got traditional IRAs, most everyone should at least consider it. And if you do think that you're going to be paying higher taxes in the future on your traditional IRA distributions, then you should definitely be considering a conversion to a Roth. So some of the benefits, there's kind of 4 main benefits that I think about. So number one, it's going to provide lower taxes if you think that the tax rates are going to be increased. So overall, even though you might be paying them up front, you would be paying lower taxes. And then once you convert it to a Roth, it's tax-free. All the growth and all the earnings on the Roth account are completely tax-free. And so, that's just a no-brainer on the back end. There's no RMD. There's no required minimum distribution. To me, that's just huge. You don't have to take anything out of your IRA. And if you don't think you're going to need it, and you want it to go to your heirs, yes, it will be taxable to them, but during your lifetime, no required minimum distributions whatsoever. And plus, you can still withdraw from it. The only caveat there is you need to be at least 59 and a half and have had a Roth in existence for at least 5 years. So those are, I think, some of the benefits for sure. Some drawbacks, we don't really have a crystal ball probably on the tax rates. I don't know if you've got one. I'd like to have one, but
I wish.
I know. So if taxes don't go up and they go down, then maybe you will end up paying higher taxes in the current year. And another drawback is that the tax is due during the year in which you do the conversion. So it's usually a large chunk. That's where maybe a partial conversion might be considered. You might want to think about that a little bit more. And then the other thing is you really want to take funds from outside the IRA to be able to pay for the tax. That's really kind of the only way it's going to be beneficial for you. So you not only have to pay the tax, but you've got to pull it out of other funds that are, could be used for other things that you want to, your discretionary funds, let's just say. So, at Hightower, you probably have IRA accounts and retirement accounts, but then you've got their other general investments. And so you're going to have to take from those accounts and spend down that money. And then one caution too that some people don't realize, but you cannot convert inherited IRAs to a Roth. So some people, I had to kind of bring them down off the shelf. They can't do that because those have those required minimum distributions usually in place. So,
right.
And then another thing that I think some people have in place that they really need to consider is who are the beneficiaries of their IRAs? Do they potentially have a charitable beneficiary? If you have a charitable beneficiary making a Roth conversion, it's never going to be taxed when the charity receives it. So paying the tax now, unless you really feel you're going to live a long time, it might not be beneficial from that perspective. But, it's still something to think about. I don't know. Those are some thoughts that I had. So.
Yeah, no, absolutely. I think that's our biggest takeaway for a lot of our clients is making sure that we're filling up those lower tax brackets and doing a lot of the partial Roth conversions, but also making sure that they're aware that tax due needs to come from somewhere else, because the numbers don't make sense.
Not at all.
When you take it out of the IRA distribution, it just doesn't really work.
It doesn't work at all. Yeah. So you really want to factor that in. And considering partial distributions definitely is something that some people might want to consider going forward.
Great.
Yeah.
So sticking with the investments, can you talk about capital loss carry forward, how to utilize it, why it's important, and maybe some things to think about when we have market volatility in the markets?
Sure. So capital losses, if someone doesn't understand how they work, but capital losses first offset capital gains. So short-term and long-term, you offset those. And if by chance the capital losses exceed your net capital gains, then you can deduct the capital loss of up to $3,000 per year. And but that can be against ordinary income, or it would be against ordinary income for the most part. So, it can be beneficial, but it is only $3,000 per year. So if you have a $100,000 loss on an investment, that's going to take you a long time to use up $3,000 per year, unless you have other capital gain income to offset. So you want to look at, and I'm sure you all are doing this at Hightower every day, you're looking at what are the investments for your client, and are there ones that are poorly performing? If they're poorly performing, should you get rid of them, and should you cut your losses now as opposed to letting them go to zero? Or, take some advantage of what is left in there and take some losses. Again, they can be used to offset other capital gain income that you may already have for the year. But at least consider what investments might be poorly performing. Also consider worthless investments. Maybe someone's got an investment in a partnership, not with Hightower, but outside of what you have invested for them. So they might want to do some sort of consideration. Is this investment worthless at this time? And if so, they should be deducting it in the year of the year in which it becomes worthless. Non-business losses can be deductible on a short term as short-term capital losses, and business losses can create some ordinary offset ordinary income. So those are some things to consider there. So if you have, though, some capital losses to carry forward, some people might want to consider taking the capital losses this year if they know they might have a liquidity event and in a higher tax bracket next year. Again, you want to really still look at what the investment is and how it is performing, and that's where Hightower, I think, comes into play to really give someone advice as far as what they expect that investment to do. But knowing that you can carry them forward, and they carry forward indefinitely. So that's a really good piece of knowledge. The other thing to watch out for is wash sale rules. So sometimes people have a large amount of gain and they take a loss just to offset the gain, which is great. But you can't buy that stock back anytime within a 60-day period, before 30 days before, 30 days after the sale of that stock, or the loss won't be deductible. So I'm sure you guys talk to your clients all the time. They want to buy it right back, correct?
That is correct. Yeah. I mean, I definitely, in March and April of this year, there was a lot of tax loss harvesting going on. Fourth quarter of 2018, the same thing where, we never want to see a down market. But when we do have down markets, it gives opportunities to harvest some losses, to reallocate portfolios, or to simply generate a little bit of loss to kind of offset some gains that were that happened throughout the year.
Right, exactly. So it might not be capital gains, like we said. 3,000 can offset ordinary income, so you do get some benefit.
Right. Great. So 2020, obviously a crazy year for a lot of things, but with the CARES Act that was passed, it gave individuals a required minimum distribution holiday, basically, not forcing them to take that required minimum distribution. Can you just talk about what you need to think about if you took that RMD and then rolled that back into the IRA account? What should you be thinking about telling your accountants? And then maybe going forward, how will the RMD be calculated for 2021?
Well, so definitely letting your accountant know that you did not take your RMD or that you rolled it back, because last year we probably factored into your estimated tax payments or into your withholding, as we discussed earlier, the fact that you were going to have that required minimum distribution or a similar amount in 2020. So we've had a lot of clients either roll them back or just they never did take anything for the year. So that's definitely something to let your accountant know and plan for that. You might be able to decrease your final estimated tax payment for the fourth quarter if you've done that, because some people don't realize that that was factored into their estimate payments. On a go forward basis, the one thing to know, if you did not take anything or didn't take all of your required minimum distribution in 2020, that is going to increase the amount of your required minimum distributions on a go forward. So let's say you have 10 years left in your life expectancy of your IRA and you deferred $100,000 from this year. So that might mean at least another $10,000 of taxable income. So if you're in higher tax brackets during the next few years, we don't know exactly what that's going to look like, but you have to be prepared for that. And this year has been, it's been no typical year, that's for sure. So sometimes we might want to consider accelerating some income into 2020. If you're all of a sudden you realize you're in a lower tax bracket this year because you didn't take that IRA, and next year when you take it, it's going to be taxed at a higher amount, you might want to go ahead and consider taking something from your IRA this year. Let's say you're in the 24% bracket and you've got like 30,000 to get you up to the 32% bracket. Maybe consider, taking a distribution to get it taxed at the lower rate rather than maybe at 37% next year. So,
right. Yeah. And I think, for a lot of our clients too, that especially the ones that have retired early, let's say 60, and they have till 72 to take their RMDs out. When they're going to be in that lower tax bracket, we always, especially working with folks like you, to come up with a good plan to maybe start taking out some IRA distributions a little bit early at that lower tax bracket. So that's a great strategy.
Yeah, something to think about. And then, with the Secure Act, one thing you do want to kind of think about is who are your beneficiaries? We talked about charitable beneficiaries, but if you have a trust named as a beneficiary, you want to definitely look at that trust document to see just how the required minimum distributions are going to be handled after you pass away, because that stretch IRA time period over a certain, a person's life expectancy has gone away now. So now we have a 10-year payout for inherited IRAs. And during that 10-year payout, there's no required minimum distribution, but you have to take it within that 10 years. So there could be, a surprise if a trust is named as a beneficiary and it states that you should be taking out the RMD every year. Well, there is no RMD. So
Right.
it might all end up getting taxed all at one time in the 10th year. But generally speaking, I think you want to, consider who the beneficiaries are. So
That's a great point.
yeah.
So going back to charitable planning strategies, what are some good ideas for individuals to think about either utilizing today for plant giving, or maybe in the future?
So we talked a little bit about the standard deduction being higher, and so not everyone can itemize every year. So one thing you really want to think about is bunching your charitable deductions and your itemized deductions. So if you can itemize one year and not the next couple of years, try to do that. Try to bunch your charitable deductions as much as possible to be able to utilize the itemized deduction. And then still use the standard deduction in the other years because it's so much higher these days. And in order to do that, one vehicle that a lot of people use are donations to a donor advised fund. There are some limitations on how much you can contribute. It can only be up to 30% of your adjusted gross income, but for a lot of people, that's still a large amount, and it will still enable you to itemize. And then over the next couple of years, let's say you use the donor advised fund to make contributions to your charities rather than coming out of your personal pocket, so to speak. And so, that makes it doable to be able to bunch and get the itemized deductions every so many years rather than every single year, and kind of not getting as much benefit. And the other benefit that I think is huge now is the qualified charitable donation from IRAs. So if you do still have your traditional IRA, you can use the required minimum distribution. So let's talk about 2021, since 2020 doesn't have required minimum distributions anymore. But let's say next year you can donate from your IRA up to $100,000, and you can do that every year of your required minimum distribution. And basically, it excludes the required minimum distribution from your income and allows the money to go to charities. You don't get another deduction for it, but by excluding it from income, you've basically taken that deduction. And so if you do that, and then you can still use the standard deduction, that's like a double benefit in my book. You've really increased your tax savings by doing that. So one thing that you have to remember is you have to be age 70 and a half to be able to make that qualified charitable donation. They did not change that to age 72 like they did the required minimum distribution age. So it's something to remember, but they kept that at age 70 and a half. Yeah,
which is a little odd, but yeah.
A little odd. I thought that as well. But so I think that's a great tool. And then the CARES Act did give a little bit of a benefit to those with smaller incomes. They can still use the standard deduction, but there's an additional $300 deduction that can be taken above the line for charitable donations during 2020. And I think that came in with the CARES Act. So that's another benefit that can be utilized by all individuals, kind of small or large. So some benefits to think about and things to consider on the charity side.
Yeah, absolutely. And most people give because they want to give, but it's always beneficial if we can do it in a tax efficient manner.
Yeah, and I think this year, given it's the end of the year, there's a whole lot of charities who have not seen the kind of donations that would normally have come their way during a year because of the coronavirus. And so, as much as people can consider it from a tax perspective as well as a personal perspective is a great thing. So
absolutely.
Yeah. Mm-hmm.
Well, Ann, I want to thank you for taking the time out of your day and
Sure.
to kind of go through some of these topics. You're a trusted advisor to us, and we appreciate the wisdom. And we hope you have a good rest of the year and a good start to 2021.
Thank you very much. I wish the same to you. Hightower is a great organization, and we love working in collaboration with you guys. It's a real team effort, I think, whenever we have clients that we share, and hopefully they all benefit from your knowledge and our knowledge, and through the end of the year, hopefully they'll benefit from a few of these tax ideas. So thank you very much. I appreciate it, and happy holidays to everyone in Hightower.
Absolutely. Thank you to you too.
Okay.
So if you would like any information on anything we discussed, please feel free to reach out to myself and we can get you that information. Thank you very much, everyone.
Thank you.